Good morning, and thank you so much for being here. I am Dr. Brian Caputo. I'm the president of the College of DuPage. On behalf of the college, I'd like to welcome you to our campus in today's economic forum. When COVID-19 fully hit in March of 2020, we were all forced to make major changes in our lives. Business operations were modified. Education switched to remote learning, and daily routines were altered. What we hoped would be a short-term disruption became a long-term situation. While we cannot go back to the way life was before COVID-19, we can learn from the experience and plan now for a strong future. Higher education faces numerous challenges as we look ahead. Last spring, the National Student Clearinghouse Research Center reported that the overall two-year decline in college enrollment due to COVID-19 reached 7.4%, or 1.3 million students. I am pleased to report that College of DuPage's fall enrollment numbers are slightly up from last year, and this is encouraging news. At the same time, we're eager to see if this is a trend that plays out nationally. But challenges remain. In Illinois, for example, the high school graduation rate has leveled out, which means that the pool of traditional age students looking to advance their education has diminished. Also, we face a growing issue with anxiety, depression, and emotional stress. A Gallup Lumina report found that in the fall of 2021, 3/4 of students in bachelor's programs and 2/3 of adults in associate degree programs considered taking a break from college due to emotional stress. This is also an issue that impacts our businesses and communities. We need to find ways to boost and maintain the emotional well-being of our students and our workforce. We must also focus on the affordability of education and making it accessible to all people, regardless of race, age, gender, or socioeconomic status. The value of higher education goes well beyond its costs, and we need to do a better job of reaching students so that they feel that education is attainable for all. As we look to the future, it is important that we work together. Businesses, nonprofits, governing bodies, and educational institutions need to strengthen their partnerships to help our students, parents, and communities, especially in the face of market volatility, inflation, and interest rates that are rising. Today, we will hear from Charles Evans, the President and CEO of the Federal Reserve Bank of Chicago, which is one of the 12 regional reserve banks across the country. Mr. Evans oversees roughly 1,400 employees in Chicago and Detroit who conduct economic research, supervise financial institutions, and provide payment services to commercial banks and the U.S. government. In his current role since 2007, Mr. Evans also serves on the Federal Open Market Committee, the Federal Reserve System's monetary policy-making body. His research, which has been published in peer-reviewed journals, has focused on measuring the effects of monetary policy on the U.S. economy, inflation, and financial market prices. Mr. Evans will present his outlook on the economy in a Q&A format with Dr. Joseph Cassidy, College of DuPage Assistant Vice President of Economic Development and the Dean of Continuing Education and Public Services. A Q&A will follow. Please join me in welcoming Charles Evans and Dr. Cassidy.
Thank you, Dr. Caputo, for that welcome, and thank you, more importantly, for your support and our board's support and our top leader support of economic development at the college, in addition to, of course, student success and serving as a center for arts and culture. Thank you, President Evans, for being here today and for your leadership at the Federal Reserve.
Thank you.
And thank you for your commitment to holding forums like this, where you gather feedback and input from real folks that help inform policy and actions of the Fed. Thank you all for being here. I understand I know we have business leaders, faculty members. We even have a few classes from both high school and college here. So thank you all for being here. I have received a number of questions already.
Great.
I'm going to do my best to get through those in what I think is a logical format. And then as Dr. Caputo mentioned, we'll have time for questions from the audience at the end. So I've been talking to folks on their way in, and over the last few weeks, I get the sense people are curious about your input on the current economic environment and what the future holds. So if you're ready, we'll dive right in.
Oh, that's great.
Perfect.
It's really a pleasure to be here. Thank you.
Thank you again. So the unemployment rate is quite low. And by many measures, the job market remains very tight. That's, of course, what we're hearing from regional employers. Yet gross domestic product, or GDP, has been down for the first and second quarter of the year, an indicator, if not a definition, by some of a recession. So let's start with a broad question. Overall, how do you see the U.S. economy currently? What do you see it doing in the next year or two and for the rest of 2022 and beyond?
Right. Well, thanks very much. It really is a pleasure to be here and share my views on the economy. This is really an unusual period of time, isn't it? I mean, the unemployment rate is low. Labor markets are really strong to the point of being tight. Inflation is high. CPI has been 8.5% and more than that. We've come out of the worst of the COVID crisis after the March 2020 shutdown of the economy for some period of time. And a lot of businesses came back quickly. Manufacturing came back quickly because they figured out how to produce safely. The tour earlier today was really a treat to see some students who were learning about HVAC systems and auto repair and things like that. Manufacturers figured out pretty quickly how to produce safely in a dangerous environment with the pandemic. And so the economy began to come back, and then households who were stuck at home, working at home, a lot of the time, ended up shifting their preferences away from in-person services like restaurants, because you couldn't go there, they were closed, to goods. And so goods manufacturers really had a boon of demand, and their capacity was really pressured. So we had strong growth coming out of that sharp downturn, and then we ran into supply challenges. And so now, a couple of years later, we are at the point where the unemployment rate, labor markets have recovered, and yet businesses continue to say that they can't find workers. So the labor market is strong. We added 315,000 jobs just last month, over 500,000 the previous month. I guess if we were in a normal, steady growth pattern, we'd expect those numbers to be more like 100,000, maybe even 70,000. So there's still strong employment opportunities, and businesses are really going begging for jobs. I think that the employment market, labor market is going to slow down. It's been slowing down for some time. Whether or not more workers come back into the labor force continues to be an important question. But I think things will slow down. We're increasing interest rates expeditiously at the moment because inflation is very high, and we need to get on top of that. That's job one, is to get inflation back to our 2% objective in some reasonable period of time. And so we're increasing interest rates, and interest-sensitive demand is going to be impacted quite a lot. Certainly housing has been affected. The housing market was on fire earlier this year. More buyers than houses and things like that. But mortgage rates are higher now, and so that has slowed quite a lot. I'm looking for GDP growth this year to be, I am looking for it to be positive. I think it's probably going to be under 1%. It's probably going to be about 0.5%. And the first half of this year was a little negative. And there's some different information about that. You can measure how much the economy is producing in two ways that are supposed to give you the same number. They don't because it's measurement. And one of them, gross domestic income, was stronger in the first half. It was slightly positive. So I think that indicates that we're going to sort of muddle through this year and have positive growth, and then get back to something more like almost trend growth, 1.5%, next year. I think the unemployment rate's likely to go up because we are tightening interest rates. I think that will eventually have more of an effect on consumers and the economy. And there are a lot of supply uncertainties as well. Risks around the globe, which I think are going to stress everybody in the business community. So I'm optimistic that we're going to be able to increase interest rates, bring inflation down, and avoid a recession. But I think we're going to have growth next year. I think it's going to be pretty decent, and I think the labor market's going to only slow a bit.
Okay. We'll come back to the labor market, and I want to follow up on the tour and get your impressions of that in more detail.
Yep.
But looking at the current situation globally, you started to talk about that. We've got global supply chains disrupted and overwhelmed. We've got war in the Ukraine. Many central banks, including the Fed, moving to a restrictive policy stance. What do you see as the biggest risk to growth over the next year or two?
Well, I am worried about all of the geopolitical uncertainties around the world. I mean, it's certainly the Russian invasion of Ukraine, the horrible conditions there that has dramatic economic implications for Europe, for energy. Russia has cut off natural gas to Europe, and it's going to be very, very challenging for Europe and the United Kingdom in that environment. They're also raising interest rates. The European Central Bank increased their interest rate today by 0.75 of a percentage point, which is a very large increase, especially for the ECB. So they are following suit with so many other central banks around the world to fight inflation. They have an inflation problem too. It's a global issue, high inflation. It's not just a U.S. issue, but so many global factors have been at work there. So I'm worried about the global economy slowing down. I'm worried about Europe taking the brunt of that. And sometimes there's a bit of complacency where we kind of say, well, we're the U.S. economy and we face different factors, and other countries can have challenges and we can sort of get through this. That is true. It can happen, but the global common experience is a little too much of the norm. So I do worry about that. I also worry about inflation expectations getting out of hand. So far, we've been able to weather. We've had high inflation. It's been very painful. We've had high gas prices. That's really affected so many people. Households on limited budgets have really been hit hard. Rents have gone up, and so it's a real issue. I do expect that inflation is going to be coming down. We'll talk more about that in a few minutes. But I worry that if the public begins to question our commitment to getting inflation back down, that it could broaden out into too many goods and then it becomes more of a problem. So I think those are two issues, the global economy and inflationary expectations.
Very good. And we will turn to everyone's favorite topic, inflation, in a moment. But back to the labor market. Let's focus on that. And there are many more positions than unemployed workers to fill them. Workers are quitting in high numbers. We've heard of the Great Resignation, and wage growth is strong. So with growth showing signs of slowing, how do you expect the labor market to evolve over the rest of 22 and beyond? And is there still room for labor supply to increase, or is the rebalancing going to come from the demand side?
So it is really amazing that the number of job openings posted by businesses greatly exceeds the number of unemployed individuals or people who say that they are willing to take a job. I mean, it's a very large discrepancy that I can't remember when that's been the case. And it would be very unusual for that to be reduced, the number of job openings. Usually when job openings decrease, it's usually because demand has declined and businesses are actively cutting back. And you're probably headed for a recession. And so that's one reason why there are many economic forecasters, businesses nervous about the path forward and what are the chances of a recession. If we are to get the job openings down to a more normal level, it usually happens in a recession. But what's different this time is everything, right? I mean, COVID, people have been, worried about going back to work. They've been shy about that. There's been a great increase in the demand for workers to work remote or hybrid. And so There are a lot of things going on, and it's been a great time in the labor market. Quits have been very high, and when people quit their job, it's usually because they get another job that pays them more. That's really been an extraordinary feature, and so there's a lot of strength in the employment on the employment side. I think that it's going to start slowing down. I think it's possible that the number of vacancies can decline without serious increases in unemployment because of the special factors that we have experienced since COVID. Wages have gone up for sure. I mentioned that quits have been very high. Businesses have been actively competing against other businesses to recruit talent. People have been able to work remotely, and so what used to be a very safe labor market in a small, localized community where the number of employers there and people who love living in that community, that's where they stay. Now all of a sudden, they're working for a West Coast firm. They're still in the local community, somewhere in the Midwest, but they're being recruited, and that opportunity to work remotely has just changed so many different features of the labor market. That's driven up wages. I think those are permanent increases in wages. It's an ongoing question is it a one-time increase in relative wages? Is it maybe payback for the fact that labor's share in income has been declining for a long period of time? Maybe they're going to get somewhat higher wages, but then from there on it'll go back to increasing with productivity. I don't think we know the answer there, but one thing we're extremely mindful of is if we get to a situation where wages go up and then businesses pass that along in terms of higher prices, and then workers kind of go, geez, I just saw higher prices, I need higher wages, that could get you into the wage price spiral. I don't think there's any significant evidence of that at the moment, but we have to be mindful of that risk.
Gotcha, thank you. So let's turn to inflation. In July of this year, the Consumer Price Index, or CPI, came in at 8.5%, I think compared to 4.7% the year prior. And I believe the Fed prefers the personal consumption expenditure, the PCE, which was at 6.3% over the same period. Right. So how are the two measures different? And secondly, why does the Fed prefer the PCE measure?
Sometimes when you've been doing something for a long period of time and, you get involved in the technical aspects to it and you make choices and then, you should be talking to marketing people. It was a horrible marketing kind of, choice to change the inflation index, which we did 20 years ago. Over 20 years ago, Chairman Greenspan changed the focus from the Consumer Price Index, which everybody has heard of. Contracts are indexed to the CPI. Social Security is indexed to the CPI. We changed to the Personal Consumption Expenditure Index. Why? Technically, it's a much better index. It's a better measure of what people actually pay. Consumer Price Index measures a basket of consumer goods, which is like out-of-pocket medical expenses. Well, that's important to you, but the PCE sort of measures total medical expenses, which is more indicative of what the economy is facing. It's also the case that the CPI has twice the weight on shelter rent as the PCE, and that was viewed as inconvenient back in 2000 when they made this switch, and this is more indicative of what people are facing. But at any rate, the PCE is what we've been focusing on. There's a slight discrepancy on average between the two. The CPI is usually about 1/4 to 1/2 point higher than the PCE. So when I say 2% is our inflation target, the CPI might be running at 2.3 or 2.5, and I would say, yep, that's consistent with my 2% objective. So that's just inside baseball kind of stuff, but yeah.
PCE does not roll off the tongue as easily, so.
Very few things do in economics, but
Well, related to this, some commentators distinguish between the headline inflation number and core inflation. Again, what's the difference and which should we be paying attention to?
Again, this is marketing, right? So, headline is what you actually pay, so when we, when you're trying to make a forecast and you want to take out some of the most volatile components, a long time ago, people took out energy prices because they go up and down, OPEC in the 70s, gas prices, and food, agricultural products because there's a lot of volatility, sometimes seasonal and other. And so core inflation is taking out food and energy. But of course, what people, eat and pay for is food and energy and everything else. And so, it's the headline that really matters. Now, the good news is the two components that are volatile usually average out over a few years, and so there's really not much of a discrepancy. Core inflation just happens to be a better indicator of what inflation will be next year or the year after that. So, so when energy prices are going up a lot, gas is going up a lot, the headline, goes up. Now, in the current environment, both have been going up, so it really hasn't been much of a difference. So, back in February 2022, this year, the CPI came out year over year at 7.9%. And the previous year, it was 1.7%. So in a year, it just leaped up. And the kinds of things that led to that were used car prices went up 40%. New car prices went up. Durable goods prices went up. People were buying durable goods. Electronics went up, and housing while you're traveling, motels and hotels were up quite a lot. But we're actively working to deal with those things.
Okay, and speaking of dealing with those things, inflation's not, it's nowhere near the Federal Open Market Committee or FOMC's target of 2%. What explains the rapid increase? I think you started to touch on it, inflation we've seen. Right. Should the Fed have acted sooner? How much of this surge in inflation is demand-driven, and how much is a result of the supply side that you started to talk about, supply-side shortages? And what, again, you touched on this, but what do you think, what role do rising wages have in this?
Right, so I did sort of start into this next part, which is, so we found that a small part of the basket, 15% of the core CPI basket, went up by 20%. And the rest of it went up a lot, but it was only 4%. So you put it all together and it was like 7.9%, and then it kept going up. At first we said, well, I think this isn't going to last because used car prices, they went up 10% in a month. That's not annualized, that's 10% that month. The next month they went up 7%, the next month they went up 10%. And so we eventually had to conclude that this is lasting a lot longer than we thought. I thought those chip shortages, when the car companies couldn't get chips to put in to the car, so they couldn't finish the car, I thought that would work its way out over the course of 6 months, but it looks like it's going to take at least 2 years to kind of work the supply chain issues out. So still, it seems to be the case that some of those supply chain issues are coming down. So, CPI was most recently like 8.5%, so it's still very high, but you can kind of see used car prices coming down and some other things. It's the other part of the basket that you really worry about because inflationary pressures have broadened out. Is that because wages have gone up and some businesses are passing those costs along? Yes, undoubtedly that's part of it. Their own costs are going up, materials costs and things like that, they're passing those along. So if it's a one-time change in all of these prices, then that wouldn't lead it into future inflation. It would be painful because you're paying more out of whatever your salary and earnings are. But going forward, it wouldn't necessarily be a problem. The concern is that it does become embedded. And a sign of that would be if inflationary pressures, inflationary expectations increased. If all of a sudden the public thinks that inflation is going to be 0.5% or 1% higher than it actually is, they're going to demand that in wages. Businesses are going to expect that in their own pricing. Now, I'm expecting that this year inflation will be high because we've already seen so much of it. So core PCE could easily be, in the 4 to 5% range. It's just going to be a big number. Next year, I'm expecting it to be lower, under 3%. I'd been hopeful that it might be down as low as 2.5% next year, but there's probably risk of 2.5 to 2.75 next year. But then after that, so many forecasters are expecting something like 2.25, maybe 2. And the point here is that normally when we're fighting inflation, you expect that when inflation's really high, it almost always takes a recession to sort of get inflation down. Paul Volcker had to create an enormous recession back in 81 to 83 unemployment went up to 10% to get double-digit inflation down to single digits. Because so many prices spiked and can be coming down, it must be the case that we're sort of expecting, if I'm going to get 2% inflation as early as 2024, or 2.3%, It's these other prices coming down that really are the big deal. The increase in unemployment that would be required to get 8.5% inflation down to 2% would be on the order of magnitude, almost like what Volcker was talking about. Nobody's expecting that. So we're expecting a lot of things to sort of improve supply chains and things like that. So, but we're looking at the data, and we're going to have to see the inflation numbers begin to improve to feel confident about that. I think that this is going to have implication for wages, workers who feel comfortable. What's your merit going to be? What's your other, increase maybe going to be? Is that enough for me to keep up? Or do I need to look for another job? Or how that's going to play out? I think those are questions that are yet to be determined. I think as the economy slows a little bit, that'll probably put a little more downward pressure on those wage increases. But there's a lot that we don't know. Have I said that already?
I think yes, but
so.
you can continue to say it, I believe. You mentioned the 1980s. I want to turn back to that in a moment. But first, I want to talk about a recent speech that Chair Powell, wherein he stated that the Fed will use its tools forcefully to restore price stability, and that reducing inflation would entail a sustained period of below-trend growth and pain for many households and businesses. So, to you, what does he mean by forcefully, and which households and businesses are most vulnerable?
I was there when he gave that speech, and he said that we'd use our tools forcefully. As I listened to the entire speech, it sounded to me like he was largely reminding everybody in the room and outside of the room what we had been saying we were going to be doing at the FOMC in order to deal with inflation. Inflation was unacceptably high. We all knew that. It was very high, very unacceptably high. And that we were going to be taking action to address that to get inflation back certainly towards our 2% objective before too long. I think a lot of outside commentators had sort of looked at a few softening numbers and begun to think that maybe the Fed was not going to stick to everything that we had said that we were going to do. Inflation right now is job one. We don't want to take actions against the economy and the labor market that are unnecessary, but we are going to have to take actions which are necessary to get inflation down. And by getting inflation back down to low and stable territory, which is our target, we're all going to be so much better off going forward, because when prices are easier to forecast, businesses can make better decisions, households can make better decisions. You can feel more confident about the wage and salary that you have agreed to with your employer and how you can provide for your family and everything else. And so more certainty there, and we've experienced good outcomes when inflation's been low and stable. So that's what we would like to get back to. And it seemed to me, I'm only one person, the chair was reminding everybody about what we had said in our summary of economic projections. And in our summary of economic projections back in June, we're going to do this in just a couple of weeks, again in September, we had a forecast. We said where we thought inflation would be going, where the economy would be going. Things have evolved a little bit more since then. Inflation's probably higher than we thought. But we had said at that time, it looked like at the end of this year, the federal funds rate, our short-term policy rate, would have been increased from our zero level, just as recently as March of this year, to about 3.25% to 3.5%. And so that's a big increase over a short period of time. We said we would do it expeditiously. He decided to say forcefully as well. But it seems to me like that endpoint this year is pretty forceful. And then into next year, we were going to pretty much kind of top out at about 4%, 3.25% to 4%. And that's a forceful use of our tools. So I kind of listened to that, and I kind of said, this sounds to me like repeating our summary of economic projections to people who had not been paying attention before or thought we might be changing our resolve. We aren't, we haven't, we won't. So that's what it meant to me.
Okay, thank you. So you mentioned job one is addressing inflation. I think another mandate, of course, is full employment. There's a potential, it seems, for these two goals to be in conflict in our current situation. And I think that's what maybe has some of us thinking of the 70s and 80s. Now, I was a pretty young person at the time, but I remember a heaviness in the household of just not of uncertainty. From that period, I learned from my father, only do a fixed loan, right? No adjustables. Well, and we thought 7% was great when that came around. So how is it different now? Is it possible we'll see another situation like we saw in the 1980s?
Well, we're committed to not repeating those experiences, and so I think an important part of our long-run strategy is that we seek to achieve price stability, which we defined as 2% inflation over time, on average over time. And so, I've been president of the Chicago Fed coming on, I have been 15 years, just last week. And for about 13 of those years, I was arguing that inflation was below our objective because it was lower than 2%. Like I said, back in February 2021, the CPI was 1.7, then it leaped up to 2.2. So, now it's higher than that. So we made a modest adjustment to how we stated our long-run strategy to say that we want to average 2% over time. Before we said 2% is our objective, and that kind of left undescribed well, in my opinion, how we would behave when inflation was below 2% and how we would behave when it's above percent. I think we should average 2%, and now, we're way above 2, so it's like we need to do this. But we also added language which indicated we're fully committed to maximum employment, maximum and inclusive employment. There should be opportunity for everyone. And we indicated that we, kind of wanted to see inflation as it emerged as opposed to just having a forecast that it was going to, be better. And in my mind, that reinforced that we shouldn't unnecessarily provide restrictive conditions that could lead to a recession unless we had a challenge with inflation that it was too high, and then we needed to be careful in balancing that. But at the moment, the balancing is very easy. Inflation at 8.5%, 7.5% is just much too high. And unemployment is 3.7% right now. I'm optimistic that we're going to be able to navigate this and keep unemployment to about 4.5% by the time we're done. That would still be a pretty good outcome, although it would be costly for some.
And so I think you've just said it, but for clarity, you're hopeful and encouraged that you can make these changes without bringing us to a recession or without.
That's my hope. That's my hope. I think there's a chance. I think there's a decent chance. But I think when you're raising interest rates, and as much and as expeditious as we've been doing, you have to be nervous that something is going to break in a way that you just currently don't see. We certainly have seen mortgage rates go up dramatically, and that has had quite an effect on the housing market. And we really need more housing construction around the country. One of the problems is we just have an inadequate supply of housing, affordable housing. When we talked earlier at our business roundtable about how do you get more workers into firms. Firms need skilled workers, and skills are changing, needs are changing, and we need more of that. We also need the housing that they can afford to live in and not be so far away that they have to travel an hour and more, especially with gas prices being so high. So, we don't want to unnecessarily restrict the economy and disadvantage large groups of households and businesses, but we do have to be concerned about the high inflation environment.
Thank you. Increasingly in the field of higher education, we're striving to be data-driven, data-informed in our decision-making. The Fed has said that the future moves in the fund rates will be data-dependent. What does this mean to you, both for the upcoming meeting in a couple weeks, the medium term, and does data dependence mean the Fed is giving up on forward guidance about rates?
Yeah, that's a well-crafted question. So forward guidance, let's see, so when I first came to the Fed in 1991, there were two questions. You were told if you went out and spoke in public, and as an economist, I didn't speak that much in public, but there are two questions you never answered. One, where are interest rates going? We didn't never talk about that. We didn't know to call it forward guidance back then. But the other one is, what do you think the value of the dollar should be? No, we don't do that. That's the Treasury Department. That's somebody else's job. Then we actually got into the business of providing forward guidance and indicating where we thought interest rates would go. We had to do that when, after Lehman Brothers, we ended up at zero interest rates. And when interest rates are zero and the economy is still cratering, what you would like to do is lower interest rates more, or have the fiscal authorities provide even more support for the economy. But that wasn't forthcoming, and we couldn't make negative interest rates. We kind of learned that some central banks could do that, but nobody likes negative interest rates, and they're never that negative anyway to do the job. And so because of that, one thing that you can do is you can kind of go, well, we expect that it's going to be like this for a long time, lower for longer. And that should be compounded into longer-term interest rates and borrowing rates, so it's more attractive, to sort of overcome that. So we got into the business of forward guidance. Well, a lot of people don't like that forward guidance. I mean, I'm good with that because I think that's kind of showing your work and telling people what you're going to be doing. But it makes some principals nervous. So we've more recently kind of said, we don't need to provide forward guidance. And yet, we've got the summary of economic projections, and we've got that the policymakers give an indication of where we think interest rates will be based upon the forecast that I put together. I call that forward guidance. And so I've already said, I think that by the end of this year, I was expecting the short-term policy rate to be 3.25% to 3%, 3.25% to 3.5%. Well, I mean, we're at 2.25% to 2.5% now, so we're going to have some rate increases. The question is, do I do it all now in September, or do I spread it out a little bit more? Maybe I have to go higher. I said I think we'll top out at the 3.75% to 4%, but that was going to be next year. You might hear somebody say, well, we should do it this year. Now that smacks a little bit of looking at the calendar and having calendar date guidance, but still, that's expeditious. I think that we've got a good plan in place. We could very well do 75 in September. We're going to have a conversation about that. I'm going to be listening to everybody. My mind is not made up. I do know that we need to be increasing interest rates up to a substantially higher level than where they are now. I think the precise path is less important than just constantly telling people, we're on this path, this is what we're going to do, inflation's job one, we're going to handle this. And so I think that's the basic answer to, where do I think, what we're going to do right now. But, we need to provide, more restrictive policies, make borrowing a little harder. We've got a lot of demand. We've got to get demand right-sized with supply. When supply improves because of supply chain improvement, then the higher level of demand will be completely fine. It could be consistent with our inflation objective, and that's what I would be looking for. The data dependence would be trying to measure, is demand in the right spot? Is supply improving? And I worry a little bit that if we increase interest rates too much, too quickly, we're kind of taking data dependence off the table.
Thank you. How are we doing on time, Bob? Okay. 3, okay. So we're going to jump ahead, and I want to return to your visit this morning at Innovation DuPage. So we had a roundtable with some business leaders and economic development leaders in the area. Great conversation. Thank you for doing that. And what were you able to take away from that meeting, and will it be valuable in terms of the FOMCs as you make future monetary policy decisions?
Well, I mean, you've got a great facility here. I mean, I'm just really impressed at, all the different programs you have to provide certification, training for people, whether it's auto repair, whether or not it's numerically controlled machinery, fabrication, or welding, HVAC, refrigeration systems, all the things that we know are important, things that over the many years, I think, if you go back to the 50s, unions helped provide some of this training and whatnot, and then unions are declining and sort of like getting, who's providing this kind of training? I think community colleges is a great place for it in partnership with businesses who need it. That just, reinforces the skills. So I think you've got a tremendous facility here. I was very impressed. I live about a mile away, and I've driven by these buildings, for years and kind of gone, what's in there? I've been to the theater, but I haven't, and all of that. So, really terrific. And I just think this is really important as I've traveled around our 5-state district, Illinois, Indiana, Michigan, Wisconsin, and Iowa. I've, stopped in at many community colleges. They play an important role. It's a good value proposition. Maybe it's, sort of junior college, students coming in at a good price point and then going on to another, final 4-year institution. The training here, people right out of high school, getting associate's degrees or just certificates. I just think it fits an important need, and we really need to provide opportunities for students and workers. People have been working for years and coming back and reskilling and all of that. That's an important part of that because technology is changing. And all of the kinds of things that, we had a discussion this morning at the round table, autos, electric cars mean internal combustion engines go away. Well, there's a whole lot of training that goes into figuring out how to fix a radiator and things like that shouldn't be in my electric car.
The impacts on related industry and related things that are manufactured, right?
Absolutely, absolutely. And that's just with the workforce that you've got, trying to train them, making sure that you have an adequate supply workforce. As I go around, the district, in an area like this, metropolitan area, you have a large population, you have many, many advantages. When I travel to, more rural settings where the towns are smaller and they've got it kind of figured out for the businesses, but if they want to add businesses, then where do the new workers come from and all the skill sets? They're very challenging issues, and I think the tact here is just really a tremendous one.
Well, appreciate that. We're very lucky in this area to have diversified set of industry clusters, employers who are very active in what we do at the college.
Right.
I want to turn to one final question, then we'll open it up to the audience. So your visit here today is timely for all sorts of reasons, which we've been talking about, but I also understand that come January of next year, you're retiring. So you've been the bank president for, I think, 15 years or so. You led us through the great financial crisis. Then we saw low inflation for a prolonged period of time, then the COVID pandemic, and now we're seeing this huge spike in inflation. So that's quite a ride. What broader lessons about policy making are you taking away from your time at the Chicago Fed?
Yeah, that has been an amazing list of experiences. You might have thought that every now and then, with the baseball team, you might want to change managers when things don't always go well so quickly. Now, I've been, very fortunate, blessed really to be the president for 15 years. I'm an economist by training. And when I showed up, I'd gone to FOMC meetings as an advisor before, but when I went to my first meeting in September of 2007, we reduced the federal funds rate by 0.5 percentage point, and that was just the beginning, opening bid before we got all the way to Lehman. I thought I was well trained and equipped, sort of like somebody coming through one of the certification programs here. I got this, I know how to do it, and then Lehman Brothers comes, and liquidity programs are invented, and low inflation, and people saying, well, you don't have to worry about creating inflation. That's the easy part. You got to worry about high inflation. And I kind of learned, no, it's really hard to get inflation up under certain circumstances, which was the nature of an aging world population and low interest rate environment. And then COVID hit. What I've learned is you really need to be bold. You need to examine the situation. You need to study it. You need to make a decision. And there was just many times where it's like we really needed to take action. Chairman Bernanke was the right chair at the right time. He'd studied the Great Depression. That's what we were trying to fend off after Lehman Brothers. And we took strong actions, and I just continued that vocal advocacy for more accommodation than we were often able to provide because I thought that was the right policy. I've also benefited from the diversity of viewpoints around the table. We're a very large committee, and I love all of my colleagues. I do not always agree with them when it comes to certain things. That's a benefit of our process, and I have learned, especially in the last 18 months, I would say, because I was a little bit slower to appreciate the inflationary circumstances that we were facing. I looked at the relative price increases when chips were in short supply and thought, yeah, this could be transitory, but listening more, I was convinced, no, this is much more persistent. No, we need to take action. So taking bold action, being humble, recognizing that I don't have all the answers, and listening to my colleagues and being persuaded when the arguments were good ones.
Well, I think that's good advice for all of us in any role that we're in. And I think some of my colleagues are on hand to run microphones to any questions we may have in the audience. I'm looking for, if you raise your hand, they'll find you. Right here. Josh, if you would take it. Thank you.
Well, first of all, thank you very much for doing this. But one question that's always kind of troubled me with respect to interest rates is, in the U.S., we have the highest quality, most liquid fixed income market in the world. Yet our interest rates in global comparison tend to be higher. Can you share some attribution for that?
Interest rates are higher?
In the U.S. relative to foreign,
I wouldn't have.
Japan, Germany?
Japan's had a huge problem where they haven't been able to.
EC?
Who?
The European Union?
Well, okay. So, all right, so coming out of the great financial crisis, okay, so when we were looking at the great financial crisis, we were looking at a deep recession and interest rates around the world fell dramatically. And that's an indication that we're in a very large recession. Then the U.S. came out of it better than everybody else. And as a matter of fact, Europe went into it later. They went into it in about 2010, and then they had a currency crisis. They had a debt crisis with, Italy and Spain and Greece and all of that. As we were doing better, our interest rates were higher than the ECB. That is correct. But that was a sign that we're a stronger economy. Japan hasn't been able to get inflation above zero for a long time. They've been working really hard at it. They've been buying assets, and it's only recently that they have seen inflation go up. When we're at 7 and 8% inflation, they're at like 1.5. So they've had a very low interest rate environment because they've been trying to get inflation up. I think the point here is that our slightly higher interest rates over certain periods of time have indicated U.S. economy is much better. When the German Bund was at minus 70 basis points, that's because people were worried that Europe was really in a tragic situation and wasn't going to be able to get out of it. So in that particular case, positive interest rates were better.
Okay, over here, Tom.
Thank you for coming, President Evans. My question is really around the Federal Reserve. You say there's 12 banks. How do the Reserve banks work together and coordinate their policies?
We have 12 reserve banks around the country. This is the Federal Reserve Act that established this system in 1913. And the act said that there would be, somebody decided there would be 12. I think the act said somebody would get together and decide how many there would be. The group decided 12. Then where would they take place? Most of them are east of the Mississippi. Because if you think back to 1913, most of economic activity was there. There's a bank in Cleveland, and on the West Coast, there's a single bank, San Francisco. San Francisco's in charge of the entire West Coast, Alaska and Hawaii, and some of the mountain states. Back in 1920, I saw on a map one time at the Electoral College that Ohio had 20 electoral votes. California had 10. So that gives you an idea of, at that time, we're located mostly on the eastern part of the United States, not enough on the west. Now, first thing that tells me is that monetary policy needs to be a national policy. Otherwise, there ought to be more reserve banks west of the Mississippi, just for fairness of perspective. So we go to Washington, we talk about monetary policy, we listen to economic conditions in each reserve bank district. I talk about the Midwest. We're heavy manufacturing relative to other districts. And that's another take on how the national economy is doing. But then we quickly get to, so in terms of national policy, we need to do this. So we have to work together and come to one viewpoint there. And there are famous cases where, back in the late 80s after the Berlin Wall fell and, defense expenditures were being cut, California was suffering because of that aerospace industry. And the president of the bank at that time said, California is really a basket case, we're having trouble. But having said that, inflation's too high and we need to increase interest rates. And that was not good for California, but it was good for them. We do a variety of, we're 12 banks. There are things that we can do together to be more efficient, like our healthcare system, how many different plans do you need, things like that. Financial services, we operate across all 12 banks with a national business line that we continue to improve. We're implementing a new real-time gross settlement payment system so that, I don't know how many people here write checks? Students raise their hands because you have to mail in a rent check usually, that type of thing. But they're more likely to use Venmo and Zelle and things like that. But you still might be subject to a 1 or 2 day delay because of ACH kinds of things. Well, we're going to make instantaneous payments available, I believe, next year. It's called FedNow. And it'll be in competition with the clearinghouse, and so that should provide competitive pricing and things like that. So we do that, and we work together across the 12 banks. And then the bank examiners, it's national banking these days, and so we kind of work across Reserve Bank lines in order to be efficient and all of that. We're always careful. We're fortunate our funding comes from so much of our balance sheet, and we have to be very careful about using our funds wisely because what we don't use properly goes back to the taxpayer.
Another question in the back there, Tom?
Hi there, thank you very much for coming. Just a question for you. How much does the market expectation play into some of your decision-making processes? So for instance, like the FedWatch tool right now in the CME group has you 86% at a 3/4 point raise. So do you guys look at that as part of the process, or do you kind of have your own, I know you have your own set of tools based on what you said, but does market expectation play into some of your decisions?
We definitely pay attention to market pricing. Market expectations are built into market pricing. We try to tease out what inflation expectations are from that. We have fancy finance models to tease out risk premia, inflation risk premia, and things that vary. So yeah, we definitely pay attention to it. Now, how much information is there versus how much noise? That's always a question. In general, when we say data dependent, question isn't so much do we look at piece of information X, it's more like is there a piece of information that we do not look at? There's usually something that somebody is, if somebody measures it, there's usually somebody who's paying attention to it. It's either in the beige book or in a staff report. But yeah, we definitely pay attention to market pricing. But that's also, it's a little bit like looking in the mirror too, because the markets listen to me talk, or Chair Powell properly. If Chair Powell says forcefully, that gets a forceful reaction, from the markets. Sometimes markets get ahead or they go in a different direction, and so making sure that we share all the information that we have, and I think the summary of economic projections are a really useful part of that.
Okay, yes, Tom.
Yes, hi. Mr. President, thank you for being here. And I had a question. For years, I know the Fed has examined and looked at cryptocurrency as part of measurement and supply M1, M2 type of things. The Fed changed their position or re-examined the incorporation of cryptocurrencies into your money measurements?
That's a great question. I don't know the precise answer. So if you're going to stump the president, it's usually over measuring M1, M2, or M3. We stopped publishing M3 back around 2005 or 2006, and there were a lot of monetary conspiracy theory people who thought that we were hiding, all the inflation stuff like that. The challenge with the monetary aggregates is that they're informative if money demand is stable, if velocity is stable, and it hasn't been stable for a long time. Now, when you mention cryptocurrency, if cryptocurrency is successful in taking up in size and with transactions, that would be another example of why money demand would change, and it would probably lead to more volatility in velocity. Trying to figure out the relationship that financial instrument would contribute to those measures would be important for getting a better signal. The problem has been we just haven't been able to tease out a signal from that. On cryptocurrency per se, we do study that and pay attention to it, certainly from a bank supervisory standpoint, financial stability risk. perspective, we pay attention to that. I worry about cryptocurrencies that place high value on anonymity and who is it who's using that, what are they using it for, because lots of times it could be underlying nefarious activity. It could be illegal operations, terrorist operations, tax evasion, and things like that. The Federal Reserve published a white paper saying that we are studying whether or not the Fed should consider creating a central bank digital currency that would be a competitor for cryptocurrencies. What types of properties should such a digital currency have? Would it be a good idea? We basically raised more questions than provided answers. Other foreign central banks have been looking at this. My own view is I kind of think this real-time gross settlement product, FedNow, would have a lot of the properties that most people would want from cryptocurrencies. Immediate payment, being able to move something, immediately would be, very important and useful, and it would be final as well. The central bank digital currency would be final. Cryptocurrency, ultimately, you're still going to want to convert your Bitcoin wealth into dollars. And so those are some of the issues, I think, that we're still dealing with.
I think we have time for one more question, and that was Dean Rudisill, who was also, I think, a professor of economics, so that wasn't fair.
Hi there. My question relates to quantitative tightening. You started your career in 2007, I believe you said, when quantitative easing happened. And it's reported that $95 billion per month of quantitative tightening is happening. Most of that's going to run off. Bloomberg, I just checked in my phone, has reported $30 billion in September and October that is actually going to have to be sold in the near term, affecting the 2-year and short-term interest rates. As an individual investor, or maybe just as you could comment about this unusual amount of treasuries and securities hitting the market. Thank you.
Right. So, one of the tools, I guess when Chair Powell said we would use all of our tools forcefully, our tools are short-term policy interest rates, the Fed funds rate, moving that up and down. And then when we couldn't move the funds rate down anymore, we started buying treasuries and assets, mortgage-backed securities as well. And we did that in order to increase liquidity. The size of our balance sheet went up. I also think an important part of that back in the first financial crisis, was we were indicating we would forcefully defend our inflation objective, and we were in it to get inflation up to 2%. And by doing this month after month after month, we were clearly adding a lot of liquidity. Now, we ended up with a very large balance sheet, and before the crisis, our balance sheet was a smallish $800 billion in treasuries in 2007. Now, the size of the balance sheet ought to be some proportion of GDP, but we were way above what we probably thought was healthy, and so we wanted to unwind it. So quantitative tightening is unwinding what we bought. And there's a certain natural aspect of just, we bought, and now we're going to let it roll off. And we did it at a pace that is less than what we bought it at, so that gave markets more time to digest it. It also gave the economy time to grow into a larger balance sheet, so we didn't have to round trip as much of that. But it does have those interactions with financial market investors, usually hedge funds and large institutions that are trying to do things at the same time that we're letting things roll off. Private investors have to absorb more of the Treasury supply, and there's more Treasury supply coming with all of the deficits that we did productively with COVID relief and all of that, and further deficit spending. So that puts pressure on things. Having said all of that, 10-year Treasury rate last I looked was about 3.25%. If anything, investors highly value safe debt. And U.S. Treasury debt, for all the complaints anybody might have about deficit spending and divided government and all kinds of things, U.S. Treasury debt is highly valued by foreign investors. If anything, they probably have a greater appetite for more than less. So all of those factors come into play in terms of how it will play out with market functioning. But we're basically committed to round tripping as much of our balance sheet as makes sense to maintain an ample supply of reserves so that markets function well.
Thank you. This has really been a treat, Charlie. Thank you so much.
Thanks.
My pleasure.
Thanks very much.